Hello and welcome to the latest of our Insider Interviews video series. Today I have with me Simon Brazier, who is the fund manager of the 91 UK Alpha Fund. Simon, thanks for your time today.
It's great to be in here, Carl.
In terms of valuations, where are you finding the most value in the UK market, and are there any sectors of the market that are looking too pricey for you?
Well, if you'd asked me this only 2-3 months ago, I definitely would have said that there were certain areas of the market, particularly some of the growth cyclicals, that have got to, in my mind, crazy valuations. And not only that, some of the companies that had good sustainability characteristics, I think, had been given a valuation premium that was probably above what the actual company deserved. We've seen that actually come off in the last few months. I still think, for example, in the cyclical area of the market, I would rather be exposed to companies that have still got their normalisation of their revenue still to come through. So some of the airlines or JD Wetherspoons in the pub sector, or a business called Essential, which I own, which has some events which they haven't held for 2-3 years, that revenue is still to come through, rather than maybe being exposed to companies such as the UK house builders, which have seen such strong revenue and cash growth over the last few years in a period of what I think will be a more difficult environment for the consumer. I'd rather be in the value names of Ryanair, EasyJet, Wetherspoons than maybe in some of the big ticket items in the UK. So that's an area where I think there could be difficulty.
And over the past couple of months, what have been the most recent changes made to the fund?
Yeah, I don't change the fund a lot. I mean, we are long-term investors, and there's a big chunk of the portfolio, many of the shares I've owned for a very long time. I mean, I would say there are two dynamics that we're always looking at. One is the sort of, everyone says it all the time, but that cost, the opportunity cost of owning stock. So, for example, we own a business called Convatec, which is a medical device business. It's in a restructuring mode. It used to be owned by private equity. Karim Bittar is the chief exec who came from Genus. The latest results demonstrated to us at a meeting we had with him that he's really on track with that restructuring. Whereas the other big medical device business we own is Smith & Nephew. We still think it's got good opportunity set from here, but we sold some Smith & Nephew to buy more Convatec just because of the opportunity set there. More widely, what we have been doing at the beginning of the year was taking profits in some of the companies that have done very well for us. So I mentioned the savings space at St James's Place had performed very, very well, and in valuation terms we then sold in order to buy the Schroeder non-voting shares, which had hit a 7% dividend yield, and the relative valuation looked more attractive. The other thing we have been doing is adding to names that have underperformed. So London Stock Exchange, which actually has bounced back more recently, we added to earlier in the year. And even HomeServe that we've been adding to, fortunately we've seen a bid for that recently. So there are areas of the market where we have been seeing value, and we're looking to add our capital into those areas. So I always joke, one of the most complicated formulas we use is buy low, sell high, and that's what we try to do, is recycle our cash from companies that are performing well, which become bigger parts of the portfolio, into companies that have underperformed where we've got that longer term conviction.
And does the backdrop of high inflation and interest rates moving upwards have any influence at all on your buys and sells?
Significantly, and I think particularly around the consumer. I mean, as I said to you, I only want to buy consumer names where I still think revenue is going up. I think EasyJet and Ryanair will have higher revenues than they did last year. But I think there's other areas of the consumer sector where I worry about the ability for people wanting to still buy houses, kitchens, some of the bigger ticket items. So definitely, the pressure we're going to see on real incomes in the UK and also across the world is one area. One also has to take into account, I suppose, the impact that has therefore onto companies' supply chains. And we want to find companies that have pricing power. Yes, they've been hurt a bit more recently, but the likes of Reckitt Benckiser and Unilever do have pricing power. I mean, I mentioned earlier being in Finland with Sigma Rock. Interestingly, them, Breeden Aggregates that we met recently, CRH again in the aggregate space, these are companies that are able to push that pricing through onto their customers because they're typically local markets and they have pricing power. So that's what we're trying to find in this type of environment.
The UK market has held up relatively well over the past month or so since Russia's invasion of Ukraine.
Yep.
Are you surprised how well it has held up?
Well, it's interesting because at the market level, you're right. I think the first quarter of this year, the market was basically flat. Having said that, I think 2/3 of stocks underperform the market. It really has been the likes of healthcare, tobacco, oil, mining, particularly oil and mining. I think in the first quarter, both sectors were up nearly 25%. Most sectors were down. So I'm not surprised because it's the dynamic of the market rather than I think actually there is pressure coming through. Having said that, the UK market relative to its peers has been a terrible underperformer for a long period of time. And I do think there has been some realisation that some of these larger companies in the UK have looked relatively attractive to maybe some of their US and European peers.
The UK stock market has been out of favour for a number of years. Firstly, there was Brexit uncertainty, and then along came the COVID-19 pandemic. What do you think the catalyst will be for investor sentiment to improve towards the UK?
I think it's going to take some time, and actually, I speak to many investors across the world, and some of them are still worried about Brexit because we still haven't seen the full outcome play out. For example, we're still not imposing checks on goods coming into the UK from Europe, and that's something that's thrown at me by some of my investors about worrying what will the outcome of that be, for example. COVID. Look, we all hope that we are in a period now of normalisation, that we won't have a terrible new variant that comes about, so that will certainly help. The final point, though, is that the UK remains quite a large stock market. But, as you said, there has been that uncertainty. Personally, I often believe people buy when things go up rather than when they're going down. So it could become a bit of a virtuous circle. And once you start to see the UK outperforming other markets a little bit, it encourages some of those investors to then come in. It's a terrible thing to say, not everyone buys low and sells high. So I do think, if we do start to see that, what I do know is that many of my clients are underrepresented in UK versus their benchmarks. So I think if you saw a bit of a tailwind here, you could see that money flowing back in.
And the final question, which we ask all fund managers, do you have skin in the game?
Very much so. Significant amount of our pay is deferred, which goes into our funds rather than shares in the company. So I have that. Also, one of my most interested and keen investors in my fund is my father. So most family events, I'm grilled about my stocks by him. So if there's any skin in the game, it's definitely that my father is keeping a very close eye on me.
Simon, thank you for your time today.
Thank you.
That's all we have time today. Do check out the rest of our insider interviews on our YouTube channel, where you can like and subscribe.